Timing the market is difficult. If you're too early or too late, it can cost you. And it can be said that the market has a knack of making a fool out of all of us at times. So how do you stop the market from making a fool out of you? Well, you need a strategy, and one such strategy that we're going to cover in this video is having a set asset allocation and then sticking to it. Investing can get emotional and sometimes it hurts. And us humans, when it comes down to it, we're just animals. We're pack animals and we have a natural instinct for running with the herd, even when it's to our detriment. When it comes down to investing, running with the herd, that is buying when everyone else is buying, selling when everyone else is selling, well, if you get in the habit of doing that too much, you're probably not going to make a lot of money. At best, you're going to have mediocre returns. At worst, you're going to cop some losses. And then after you've taken that fancy new haircut, well, when the time comes to jump back into the market, when it's time to make some money, you might be too scared to jump in. One way to get around that problem is to set up an asset allocation strategy and then stick to it. And I'm not saying here that asset allocation is the holy grail of investing. It might suit you, it might not. But what I am saying is that asset allocation is a great way to remove emotion from the game. Follow the allocation rules and it will force you to buy low and to sell high. Or if you're still in the accumulation stage, so you're still building your portfolio, it's going to force you to direct more new money towards undervalued assets and less new money towards overvalued assets. Now, when I say undervalued and overvalued, the context that I'm speaking in here is whether a stock or an asset of some kind is overvalued or undervalued when comparing it to the rest of your portfolio. I'm not talking about intrinsic value, free cash flow, discounted cash flow, none of that stuff. All we're saying here is whether a stock is cheap when compared to the rest of your portfolio. That's what asset allocation is all about. Now, the first thing you have to do is determine your asset allocation split. So this is working out the main categories of your investments, the pools they're going to form, and you're going to be looking at things like stocks, real estate, bonds, cash, crypto, metals, anything like that. It doesn't really matter what it is. It can be anything you want it to be. You just have to make sure that you're investing in things that make sense to you, that you believe in, and that are in alignment with the goals of your portfolio. For example, do you believe in tech, crypto, or more traditional sectors? And are you looking for income, growth, or do you want more of a defensive capability to your portfolio? Your tolerance for risk comes into this. So if you have a high tolerance for risk, you might direct more weighting towards stocks, maybe crypto. And if you're more conservative, you might put more weighting towards bonds and gold. And also your stage in life plays a part. If you're young and you've got 30 to 40 years of investing ahead of you, you might focus more on growth assets. But if you're a bit older and you're nearing retirement, you're probably looking more for reliability of income and stability in your portfolio. Okay, so a common method for asset allocation that you might have heard of is the 60-40 method. This basically means that 60% of your portfolio goes to stocks and growth assets, while 40% goes to bonds or defensive assets. And it is a very traditional method, but it's not without its critics as well. Especially in 2022 when bonds have been getting hammered at the same time that stocks have been getting sold off. Now, this is a little bit unusual because normally when the markets are volatile, you look for bonds for stability, but that hasn't been the case this time around. Further to that, many government bonds have been yielding less than the rate of inflation. So that means in real terms, you're actually losing money. And this is largely due to the lunatic central bank policies and the quantitative easing at all costs approach that the developed world has largely adopted over the last 10 years or so, and really has a lot to answer for in fueling more financial instability and more inequality. But that's a whole other topic altogether. Okay, so the point here is that no asset class is perfect, be it real estate, stocks, cash, crypto, bonds, whatever it is, it doesn't matter. They all have their flaws. What you want to try and do is take a diversified approach to your asset allocation that is in alignment with your investment goals. Right, so let's get back to the allocation split. The first thing you need to do is select which asset classes or categories you want involved. So let's say that you want some stocks, some real estate, or REITs we'll use here. And you're going to use that for the growth part of your portfolio. You also want some bonds for reliable income. Let's also say that you want gold for a safe haven asset and a bit of crypto for speculation. So that's 5 asset classes we've just categorized there. Now, the next thing you need to do is decide what percentage of your portfolio is going to be directed to each of those 5 asset classes. Alright guys, just very quickly here, before we jump into the tutorial part of the video, I'm just going to give you a bit of a preview here of the file, the worksheet that I'm going to make available for a free download on our website. Now this is the file that we use in the tutorial coming up, but what I've gone and done is I've gone through and tidied it up a little bit, made it a bit more user friendly. So just to give you a quick demo, up here you got your asset categories, stocks, REITs, bonds, metals, crypto. That can be whatever you want. Here you've got the percentages you're going to allocate to each asset class. That can be whatever you want. Down here you got your individual stock holdings, individual REIT holdings, individual bond holdings and so forth, and the dollar amount for each one. And as you can see, we've got a total portfolio of 100,000, and our actual allocation percentages match our target percentages, and then allocation variances are 0 because the actuals match the targets. Now if this was to say go up at the end of the month to $12,000 and then this was going to go down to $8,000, you'll see now that the actual percentage for stocks has gone up to 42 and the target hasn't changed because we've left that as what it is. We're looking for 40%, and we can see we're over by 2% or over by 2,000. And for bonds, it's gone down to 28%. The target's 30%, so we're down by 2% or down by 2,000. Now in the bottom row here, if you're going to make a new contribution, I've put some notes in here as well to make it a little bit clearer. If you're going to make a new contribution here, say we're going to put in $10,000 at the next month when we've got some more savings, and this can be whatever you want it to be. So if we're going to put in another $10,000, this is telling us how much we have to put into each category to get these allocation variances back to 0. So if we're going to put in another $10,000, and we'll just demo that very quickly, and we put that money into some kind of asset, whatever it may be within these categories, now you can see the allocation variances have gone back to 0. So this is a good little indicator here, a good little tool to show you how you're tracking against your target percentages and how much you have to put in when you make a new contribution to get your allocations back to 0 or back to where you want it to be. Anyway guys, head over to our website. I'm going to put a link in the description of how you can get a free download to this. You can build on this, do whatever you want. It's up to you, it's yours. Other than that, hang around to watch the tutorial, and I hope you enjoy it and get something out of it. Okay, so here we are on a little spreadsheet I've made up, and what I've done here, I've put in the 5 categories at the top. So we've got stocks, REITs, which are real estate investment trusts, companies that invest in real estate and you can trade on the share market. We've got bonds, gold and crypto. But it's important to remember that these categories can be whatever you want them to be. You don't have to invest in crypto, that's pretty risky, but some people like to, that's up to you. And I've also put in some percentages here to make up the allocation of the entire portfolio. So I put in 40% for stocks, 20% for REITs, 30% bonds, 5% gold, and 5% crypto, and it all adds up to 100% of course. Now this is similar to what you'd have in a 60-40 portfolio when you'd consider these two to be grouped together as stocks, and then you'd have your 40% down here. But whereas crypto is not really a defensive asset, you might have cash or something in there. But the main point here, guys, is your categories can be anything and your percentages can be anything. But this might be something like what a sort of 60-40 looks like, and then you play around with the percentages to get to a position where you're happy with that. But basically the only reason I've chosen these percentages here is to illustrate the example. Other than that, you're free to do whatever you want to do. It is your money and your portfolio. So just to recap, guys, all I've done here is picked out 5 possible categories, and I've made up some percentages here just for the sake of the example. I'm not saying you should go and put 40% in stocks and 5% in crypto. You have to make your own decisions. It's your money, you know that. So you can use this as a guide, a template guide to show you how allocation might work, but then put in some real thought as to what you want to invest in and how much you want to allocate to each investment category. Okay guys, here we are again, back in the spreadsheet. I've made a few adjustments, a few additions to it. So what I'm going to show you now is how you actually allocate money to your allocation settings with the settings that you've set up here already. So let's say that you have $10,000 you want to invest. All right, so we know pretty quickly that 40% of $10,000 is $4,000. So we're going to put 4,000 in here. And we know that 20% of 10,000 is $2,000 for REITs, 3,000 for bonds, 500 for gold is 5%, 500 for crypto. And then we can see here we have a total portfolio of $10,000. Down here we have totals for all our investments. Let's just say we made the one investment for 4,000, total of 4,000, and our actual allocation percentage is 40%. And the actual allocation is down here. And then down the bottom here we have allocation variances. So let's say you've made your initial investment in month one of $10,000, and here it is. And then at the end of the month you go through, you log into your broker and you have a look at where the prices have moved over the month. So let's say during the month stocks went up to 4,500, REITs went up to 2,500, let's say bonds went down a little bit to 2,950, gold let's say went down to 470, and crypto let's say it went down to 450. So over the course of the month we've had a bit of movement in everything. Your total portfolio is now at $10,870, so you've made $870 over the month in unrealized gains. And now we can see down here that stocks is now 41%, but our allocation was 40%, which means it is over allocated by 1%, or over allocated by $152. REITs are now 23% of your entire portfolio, which is 2,500 divided by 10,870. So they are over allocated by 3% because they're 23% when your allocation was 20, or over allocated by 326. Bonds are now, they've dropped to 27%. The allocation was 30%, so they're under allocated by 3% or under by $311. Gold is under allocated by 1% or $74, and crypto is under allocated by 1% or $94. Now let's say you've got another $2,000 you want to invest in month two. So what you can do now is we can sort of have a bit of a play around and see where we want to direct our money, our $2,000, to get these variances close to zero. So bang on with these allocations here. So what we can do, we can put in $2,000 here, and we can see that our allocation variances have changed down here. So what this is telling us is if we put in a further $2,000 and nothing into stocks, if it all went into crypto, then stocks would be below, they'd be under allocated by 648, and REITs would be under allocated by 74, bonds would be under allocated by 911, gold would be under allocated by 174, and to work out the crypto, we'll just have to move this little dummy figure over here. Crypto would be under allocated by 194. Get rid of that 2,000. That was just a dummy figure. And if we highlight all this, this should add up to 2,000. 2001. So we've got a bit of rounding there, but it's pretty close. So then what you can do, we'll just take one off one of them. So then that should add up to 2,000, which it does, sum 2,000. So now we know if we're going to invest $2,000, it's never going to be exact, but you would look to get it pretty close to these figures here. Now, being realistic, you're probably not going to go, and depending what brokerage platform you're using, but you'd be looking at your brokerage fees, and you might not waste your time making small purchases if you're going to sort of get lumped with a brokerage fee. For example, with Commonwealth Bank in Australia with CommSec, under $1,000 is $10 brokerage, and then after that it jumps up to $19.95 per trade. So I know you guys are all using different platforms, but just for instance, if you were with CBA, then it's probably not worth even making a trade unless you're making, close to $1,000. But let's just take brokerage out of the equation for now. And let's say we bought a further 648 in stocks. We bought a further 74 in REITs, which you're not going to do, but just for the purpose of the example, let's say we bought 910 in bonds. We bought 174 in gold. And we bought 194 in crypto. And now, as you can see, our allocation variances have all come back to zero, and they're all pretty close. Stocks and REITs are bang on, bonds is under by $1, gold and crypto are over allocated by $1. But But we know in reality, you're not going to be trading such small amounts probably. So what you might end up doing, you might just look at our biggest undervalued allocation is bonds. You might throw $1,000 on that. And then we've got some under allocated in gold, so we throw 500 there, and we had some under allocated in crypto, so you might throw 500 there. So you'd have your 2,000 in for this month, it'd be up to 12,870. The values again would change over the course of the next month when you log in and see if stocks have gone up and REITs have gone up or whatever's happened. But if nothing changed and then you wanted to make another investment, you'd see next that stocks were under allocated by 5%. So you need to throw some money in there to get that closer to zero. And now that's on zero. You'd need to throw a bit of money into these guys. 500. Stocks is under, so you'd throw another 500 there, for instance. It's all about getting the allocation variances within a comfortable range. For me personally, I try to keep my portfolio within a plus or minus 2% if possible. So for me, I would be pretty happy with that. Everything's sort of 1%. That would be acceptable. Now, if you were doing a rebalancing, so for instance, you weren't actively buying new stocks, you weren't in the accumulation or the build-up phase of your portfolio, you were retired, you had a set amount invested, and you were just rebalancing. So at the end of the year, let's say you had 100 grand in there, and you had 45 grand in stocks, 25 grand in REITs, 30 grand in bonds, 5 grand in gold, 6 grand in crypto. Change that to 4,000. So 110, I've overshot 15. So say you had 100 grand invested. Now we'd see this, we'd say stocks are over allocated by 5%. So what you'd do to rebalance, you'd sell 5,000 of stocks and you'd buy 5,000 of REITs. And now you can see they both come into perfect alignment. And we can see gold is under allocated by 1,000, crypto is over allocated by 1,000. So you'd sell $1,000 of crypto and you'd buy $1,000 of gold. And then you're back in perfect alignment, 0% variance. But for most of you out there, you're going to be in the build-up phase, so it's just a matter of when you put more new money in, more money invested, all you gotta do is throw it on the underweight positions. For instance, in this case, you'd have REITs, gold. You wouldn't necessarily bother selling stocks just because they're over allocated, you just wouldn't put new money in. So stocks are running strong, that means the prices are high, so you don't need to put new money into stocks where the prices are high and the market's maybe running a bit on the hot side. You put money into the undervalued sections. So you put money into your REITs, put money into your gold, you know, like so. And then in time, they'd come into more alignment. And they're starting to come down towards 0 and 1%, which is pretty good. So it's just a matter of directing money into the undervalued, underweight positions, and that way you're always going to be putting money into whatever has come down in the market. So it may have been oversold, so it means you're buying it cheaper. You're putting more money into the underweight positions and you're putting less money into the overweight positions. So it forces you to put money into what's relatively, comparatively cheaper in comparison to the rest of your portfolio, and it forces you to put less money into what is comparatively expensive in relation to the rest of your portfolio. Now, the asset allocation method does work best when you don't play around with these percentages too much, because if you start saying, oh, REITs are down, well, let's take this away, REITs are down 5%, and so the market's gone down, I don't want to put money in, so you start changing this to like 15% and then change this to 45%, that sort of defeats the purpose of the model, because now you're just running with the market, you're not rebalancing. For this model to work, the theory to work, what you have to do is, for the most part, stick to your percentages, because then it's going to force you to put money into positions that are underweight and pick up the better price. But of course, markets change, things happen, so you probably will want to make some adjustments here and there. But No need to go too crazy, or I would just say give it some careful consideration. And if you're making the change, making it for a good reason, not because you're getting worried. If you believe in something, in the fundamentals of something over the medium to long term, it can often pay to stay with the ratios, and maybe you might sort of lose interest in crypto and move that down to say 2%. The markets might be looking a bit shaky. The reserve banks are printing too much money, so you say, okay, I want some inflation protection. I'm pushing gold up to 8%. Things like that. But that all said, guys, just because the model might be telling you to put money into something doesn't mean you necessarily should. You always got to apply that second filter of thought to this. Yes, it is a very good way of taking emotion out of the game, but if REITs had gone down to say 10,000 because one of your big stocks was a building company that was potentially going to go bankrupt, then of course you need to exercise some discretion there and not necessarily want to throw good money after bad. So the asset allocation model is fantastic in directing you where you could put your money to retain a strong purchasing price, but you always need to apply that second sense check in your head to say, okay, if something is undervalued, why is it undervalued? Do I believe in these companies long term? Is there nothing wrong with these companies? Like, are they not sort of teetering on the edge of bankruptcy? If you believe in it long term, then by all means put money into it. If you believe that something is getting hammered for a very good reason and you don't think it's going to come back anytime soon, then yeah, maybe go make some changes up here on your percentages. All right, so we've gone through basically how the allocation works for underweight, overweight, and putting new money in, rebalancing, and so forth. But it doesn't go into the detail here. So what we've got the main categories: stocks, REITs, bonds, gold, crypto in this example. Now, what you're actually going to have is you're going to have a bunch of different stocks. So you might have, I'll just make some stuff up here. You might have a BHP, which is the big miner in Australia, Commonwealth Bank, let's say, or you might just have ETFs. You might have VAS, a Vanguard, VSO, which is your small ordinaries. And then for REITs, you might have VAF, which is a Vanguard REIT, or REIT, which is an international REIT. And you might have sort of, $10,000 each here. $5,000 of the two different REITs. And bonds, you might have your Australian government bonds with Vanguard. You might also have your corporate bonds. You might have some emerging markets. $10,000 a piece. And then in gold, well, let's say you've got 2,000 in gold, and you might even have 2,000 in silver. And crypto, well, let's just say, Bitcoin, everyone knows Bitcoin. So what you do then, you allocate on the broader level at the 40%, 20%, 30%, 8%, 2% levels. But then you also allocate underweight in the subcategories. You've gone in at the end of the month and you've had a look how things have moved over the month. And now we're making those adjustments. Things are going up, things are going down. So you got your $100,000 portfolio. We can see that stocks, your allocation is 40%, but it's really running at 10%. It's over allocated by 10%. So it's running at 50%, over allocated by 10% or $10,000. So that's overweight. So we don't want to put any new money into that. REITs are under allocated by $10,000. So let's say if we had $10,000 to put in, you'd put more into the VAF than you would into the REIT, because this has been sold down and this is going up, provided that you will believe in VAF for the medium to long term. And for instance, if you were going to put a big lump sum in, like 50 grand or whatever it may be, and that meant putting 10,000 into stocks, well, you'd put it into your under allocated positions first, provided you believe in the stock. It's not a dog stock, it's got a future. So that means you'd put money into CBA, because that's lower than everything else, before you put money into BHP, because that's higher than everything else. So not only do you direct money based on the broader level percentages, allocations, You can also use this to direct money at the subcategory level. So putting it into what is being sold off. So VACF has been sold off, so you could look to put more money into that before you put money into VGB, because VGB is overweight. But of course, guys, always have to exercise discretion. Apply that second, that level filter, that sense check, that you're putting money into something because you believe in it, the fundamentals are solid, and you want to capitalize on a stock that's been beaten up a little bit, and you want to pick up a good purchase price to hopefully realize some gains in the future. That is what makes the asset allocation model quite a powerful thing, provided that you do give it the adequate level of analysis along the way. And of course, you can diversify further within the categories. So you might have a section for Australian stocks. If you're an Australian investor, then some international stocks. You might have some dividend ETFs, some growth ETFs, emerging markets, all that kind of stuff. For bonds, you might have government bonds, corporate bonds, junk bonds, emerging market bonds. You might have some private debt as well. But you know, when you're putting money into riskier things like junk bonds and picking up the higher interest rate, you always want to balance that out with something low risk like government bonds. It doesn't pay as much, but it's just it's in there for stability and to counter the risk of having something in a higher risk category such as junk bonds. And again, like for crypto, which is highly volatile and very speculative, if you're going to put a bit of money into crypto, then you really should be balancing it out with something quite safe, whatever it may be, bonds, gold, cash. But this is where you can use the model to provide a really nice level of diversification across multiple sectors, multiple countries, multiple asset classes. Asset allocation works best over the medium to long term. You want to at least stay in it long enough to follow an economic cycle through its entirety, or multiple economic cycles if possible. So the theory is that when the market is running hot and the stock market is peaking, you'll be buying less stocks because they're expensive, and you'll be buying more defensive assets like gold and bonds, for instance. And then when there's a market crash on the stock market, you'll be buying more stocks because they're cheap, and you'll be buying less bonds and less safe haven assets like gold. That classic Warren Buffett quote, "Be fearful when others are greedy and be greedy when others are fearful." That's exactly what we're talking about here. And the beautiful thing about asset allocation is it's going to help to push you into that direction. For someone who's not actively investing new capital, so you're just maintaining and rebalancing your existing portfolio, well, if you had an asset allocation strategy going and you were investing in the NASDAQ, for instance, well, when the NASDAQ was heading for the moon, you would have been selling and bagging profits all along the way. And then when the NASDAQ sold off to a point where it started to become cheap, or to look cheap in comparison to the rest of your portfolio, then you would have started buying again, picking up those profits and then picking up the upswing when the market recovers. So this is the theory anyway, and we know that theory is not always reality, but having a strategy is better than having no strategy at all, because whether we like to admit it or not, from time to time we all need saving from ourselves, and asset allocation will help us do that. Okay guys, that is it for the video. Thank you very much for watching till the end. Good luck out there in the markets, and we hope to see you again on the next one.